All right, good afternoon, everyone. Craig, I'm going to let you kick us off here as Craig Rubrecht is going to be hosting us this afternoon. Good afternoon, Craig. Thanks for joining Cliff and I, and I'm going to turn it over to you.
Yeah, Jeff, thanks. Thanks for having me. And let me just start by welcoming everyone to our 2021 market kickoff event. My name is Craig Rubrecht. I'm the CEO of Cornerstone Wealth. Again, thank you for joining us. Thank you for your business. Thank you for your partnership with Cornerstone Wealth. This is actually the first time we're doing a kickoff event virtually. And obviously the downside is that we're not all together enjoying one another's company. I think the benefit, though, as I look at all of you that have joined the call, it's turning out to be one of our largest events. And the benefit is that many of you who are joining from other parts of the country that wouldn't normally be able to be with us in person are able to be with us in this event. And, in a world where COVID-19 has kept us physically separated, I think it's really been exciting for us how technology has actually brought us closer together through all of this. I'm very proud of our team. We've worked tirelessly to provide service and advice from a distance. I'm always the optimist, and certainly with some of our technology partners, of course, Zoom, the medium through which we're talking today, Microsoft Teams. We've enabled some new technology through DocuSign to share documents back and forth. eMoney is another great platform that we've really been able to leverage. And again, I'm just proud to say that we've been able to continue to collaborate with all of you just as much, if not even more, than prior to this unfortunate pandemic. So as we think about the call today, we always like to provide a mix of both planning thoughts as well as market-oriented advice. And so we have two speakers today. The first, Jeff Carbone. Jeff kicked us off. And Jeff runs our private wealth, our high net worth services. And so Jeff, as he kicks us off, as we have a new administration, we're looking at some tax law changes and potentially some estate planning changes or some estate planning ideas. So we've asked Jeff to walk us through, and then he's going to turn it over to Cliff Hodge. Cliff is our Chief Investment Officer for Cornerstone Wealth. For those of you who joined us last year, you got to hear Cliff speak, and perhaps you've had an opportunity to speak with Cliff throughout the years. I know he provides regular investment updates, but we've asked Cliff to give us a recap of what happened. Certainly a lot to talk about as we recap 2020, but we've also asked Cliff to give us an outlook for 2021. And then along with that, how we're positioning portfolios given that outlook. So again, thank you all again for joining us. Without further ado, Jeff, I'll turn it over to you.
Thanks, Craig. Appreciate you kicking us off today. And thank you for everybody joining us, our clients, friends, and the Cornerstone team. Appreciate everybody jumping on in support and joining us. As everyone and most people know, Cornerstone, our mission is to provide that clarity and confidence as the cornerstone of our clients' financial lives. And we've really taken that pretty seriously because the Cornerstone team, we've really developed and refined our dynamic financial process that puts every piece of the financial puzzle together so our clients consistently have the complete picture now as well as in the future. So as Craig mentioned, 2020, very emotional year all around. Our prayers, of course, go out to those that have been affected or have lost loved ones in the truly unprecedented times we've been in and continue to be in. Two big themes, of course, last year were around COVID-19 and the pandemic, along with the latter part of the year with the elections that took place. And as we all know, on January 20th, Joe Biden took the oath of office and became president along with Kamala Harris as our vice president. With that, the Biden administration certainly had an additional boost a little bit earlier prior than taking office with the Georgia runoff and a split now Senate with 50-50, which ultimately gives Vice President Harris the deciding vote on legislation. While tax increases are still with a split Senate, their taxes are going to be an uphill battle and an uphill climb, especially with COVID continuing to wreak the havoc that it is on our economy. I'm going to confidently say it's no longer an impossibility, though. President Biden's prospects for the policy agenda are appearing more robust than we had previously anticipated. And today, I really want to spend some time going over and reviewing some of those potential tax law changes and the state tax law changes that are coming. And I say they're coming because changes are coming. We don't know when, don't know what they're going to look like exactly, or when they will even take effect, but they are coming. So I'm going to jump in. Again, we know Joe Biden is our president. Kamala is the vice president. The House remained Democratic, of course. And then the Georgia runoff, we have a split, which again, Vice President Harris has the deciding vote. What does that all mean? Definitely potential tax law increases for wealthy and for individuals. And that is set across income and estate taxes. Many clients, I was working with clients with our private wealth group, as well as with some of the advisors on completing some tax law changes that we were anticipating. And we were really working hard in 2020. But if you have not completed those changes are more pertinent than ever. The generation skipping transfer tax, gift tax, exemptions are all changing. So strategies we discussed, and we held a couple webinars on some of these strategies earlier in the third quarter around spousal lifetime access trust, special power of appointment trust for business owners, net sale transactions, or grant or retained annuity trust are all combination or vehicles that one can use during these times. In terms of the landscape, as I said, the 50-50 split, again, what that means, and just an interesting fact, this is not the first time that this has happened. Back in the 2001, during that time, the Tax Act of 01 needed to be passed with Vice President Cheney casting that final vote and the legislation going through. If everybody remembers to our government classes in school, Senate does have a rule where any senator can filibuster any legislation, but 60 senators can end that filibuster if they all vote together. There's exceptions for judges as well as under budget reconciliation, but it's a simple majority is not needed in those cases. Just a quick filibuster is just that political procedure that some people maybe recall. I think there was how many hours of back in 2017 that they were putting the filibuster in place. But it's a debate to on proposed legislation to delay or remove the proposal altogether. Again, that part of the legislation that passed, the 2017 tax legislation that passed, did not pass by a majority votes. It passed under the budget reconciliation process, which again is a little different. But it's unclear what the tax law changes are going to occur, but they're coming. So if we look at 2021, why is 2021 even more important than as we were finishing 2020? We now know who is in office and who the administration is being led by, which under the current tax laws, estate tax laws, an individual can pass on $11.7 million or use their gift while they're living or at their death. For a couple, that equates to that $23.4 million, which is extremely a large amount of money. Any of those dollar amounts above that, 40% of the tax above those thresholds will kick in. Another change in addition to, we'll talk about the exemptions, but that 40% tax is looked at, probably could be going up to 45%. Whether the Biden administration makes any changes, the exemptions are set to a sunset in January on 12/31 of 2025. So taking effect on January 1st of 2026, down to the $5.5 million. But we're probably going to see even additional changes where we definitely won't have to wait, or that won't stay until 2026. We'll see some changes sooner. And the chart on the left, I know, is a little bit blurry here, but right in the middle is the 2021, and that's where the 11.7, and you can see the continued inflation adjustments going in. But the legislation or proposed legislation that we've seen shows possibly dropping down to $5.5 million, and even possibly lower, maybe 3.5 could be in the cards. When it comes to estate planning, it's a team effort. It's not the single financial advisor, the attorney, or the tax attorney or accountant. It's the team really working together to propose the best strategies and come up with the best solutions for clients. So, a goal for estate planning is always to, utilize and protect as much money as possible for one's heirs. Again, currently the exemption of 11.7 million is in place, but as I mentioned, could be going down 5.5 million or lower. I know, advisors will also agree with me that a lot of times when we discuss estate planning, it's that shifting of the hard-earned money that we have is sometimes a tough conversation. We don't want to give up access to our money, but there are definitely more robust strategies out there today than we've had before, like a spousal lifetime access trust or a special appointment trust that can still give you some indirect control. So there's some resources we want to continue to look at. Again, the exemption is in a more favorable position today than we anticipate it being tomorrow, so need to review that. And estate planning is not just about having money go to your heirs. It's also about you protecting the asset protection for you and your spouse or significant other. Again, wealth taxes is going to change, and our estate tax system, it looks like it will be adjusting. So as we flip into the income tax changes that are on the agenda or on the proposal, one of the big things you will see in the $400,000 of income will be the number that seems to be highlighted throughout most of the proposals. The first proposal in terms of change in the Social Security tax we pay, and if you think about your paycheck, if you're working today and you have earned income, you pay 6.2% of the Social Security tax up to $142,800, and your employer pays the other 6.2%. I'm not referring to any of the additional Medicare taxes. It's just the Social Security tax that we pay. If you're self-employed, you pay the full 12.4%, but that stops after the $142,800. The proposal that is on the table is to extend the 12.4 beyond the 400,000 of income, but at the same time, it's creating a little bit of a tax-free gap because there won't be any increase between 142.8 and the 400,000. So we're continuing to watch that from the Social Security wages. Another big proposal on the agenda is the increase of the marginal tax rate, which today is the top marginal tax rate comes in at 37, looking at the restoration of that back to a 39.6 marginal tax rate. If we keep going, the itemized deductions, where there were some changes in the 2017 tax change or tax code, where itemized deductions on our on the SALT, on the state and local taxes that we pay, property tax was capped at $10,000. Any other deductions today, mortgage interest is maxed at the $750,000, but charitable contributions and some other contributions are not. On the table is to actually put some caps and anybody's, again, income above 400, there comes that number. Any income above 400 will have a cap on 28%. Big one on the table for a lot of folks is capital gains, where currently we pay 20% on any long-term capital gains. Short-term capital gains still come in at ordinary income tax rates. Proposal is on the long-term capital gains rates would be to increase that to the top tax bracket, which is the 39.6. So again, a big change there. So with the capital gains under President Biden's proposal, long-term capital gains would kick in not for all, but individuals with income of more than $1 million. So up to the million, you would not have that. Above the million would be taxes at 39.6 is ordinary, is same rate as capital gains would be as your ordinary income tax rate. And in addition to that, with the Medicare tax would still remain at 3.8 on investment income. Again, just a quick reminder again, 20% currently with the 3.8 Medicare tax on income for higher income earners, a total of 23.8. Another big item that's on the proposed list is the elimination of step up in basis. And this is a really big one for a lot of folks that have a highly appreciated stock with their parents or older individuals or the possibility of their heir inheriting money. But that step up in basis currently says if you pass away and you have a large gain in an investment piece of property, that gain gets stepped up to what the date of death value would be. So if you had you paid $10,000 for your shares of Amazon stock and they're now worth $1 million. If you were to pass away, the step up in basis on the date of one's death goes up to the $1 million. You don't have the capital gains on the $990,000. That could change where that gain would be now become taxable upon death. So definitely a big change there. And really, they're just trying to objectively smooth out income for the government. Actually, I mentioned the marginal tax rate changing again on the $400,000 of income and above. So we could see marginal tax rate. What's unclear here is how it's going to affect our filing status. So one that files single, married jointly, head of household, married filing separately, et cetera. We don't know what that's going to look like. We just know the tax rate has been thrown out there. I mentioned the SALT deductions prior in terms of they were changed back in the 17 tax code. It's not on President Biden's agenda, but it is a big Democratic agenda item, especially with some of the larger states like New York, California, Massachusetts, very heavily weighted more towards Democratic side. To the constituents, they may look to add that back in. But again, if they add that back in and it's capped at 28%, may not have as great of an effect as it once did. But it does provide some opportunities and some thoughts on how you handle your state income tax. When do you pay them? And towards the end of the year, should you pay it in December or pay it in January? Those are tight. Got to keep an eye out because those could be strategies we discuss. I'll just kind of go through a couple other opportunities or other proposals that are on the board. I won't go through all of them, but there is the expansion of the ACA premium tax credit. There is definitely the expansion of the for electric vehicles tax credit, big agenda item in terms of cleaner energy from the administration. The restoration of tax credits for residential energy efficiency. Solar tax credits could possibly become permanent, and we could see expansion of some retirement credits. So there's other proposals we need to keep on top of as well. So just a few solutions and a few, just to kind of bring it all together. If you do have highly appreciated stock or highly appreciated assets that have heavy gains, really prepare. It's time to prepare a game plan of action. Again, anticipation would not be regulation coming in the next month or two, but mid to later summer, we could have a better idea of what the proposals are, what they look like, and if they do get passed. So be ready to act just today. Consider other strategies. Gifting is still transferred assets today. are still a big item to be reviewed, and utilizing the exemption. Again, although we don't know if it could be retroactive, and that's why it's more important to work with your team to make sure, with the attorneys and the accountants, to make sure we have the ability to undo what could have been done. Don't forget, again, there's some great strategies right now that continue to have some access, and that would be the Spousal Lifetime Access Trust. Grant or retained annuity trust provides access. 529 plans are easy plans to remove from one's estate, but still provide access that you own it. Irrevocable life insurance trust, etc. Bigger items, as taxes go up, Roth conversions will continue to become bigger parts of our planning process. So again, remember Roth conversions. Social Security, again, with the expansion, more for business owners. If S Corps, a lot of S Corps have dividends as well as wages. Dividends are treated and are not taxed on Social Security. So we could see, the S corporations becoming more popular, higher dividends coming out of S Corps. But you have to assume those loopholes could be closed, and you have to also be aware of there has to be reasonable compensation or reasonable wage. It's also a good time to review your status. If you do own a company and you're a business owner, how are you filing? Are you an S Corp, LLC, C Corp? Just review your corporate status, make sure you are you're filing in the best way possible. And for business owners as well, options and deferred compensation programs become even more important as well. So again, a lot going on. Thank you for your time today. Thank you for allowing us to work for you. We appreciate the trust and confidence that you've placed in us. And I'm going to hand it right back to you, Craig.
Yeah, Jeff, thanks. Thanks for sharing that with us. I think, with change come a lot of questions, and you've certainly helped us in the first step of demystifying what that change might entail. Certainly, the bulk of the changes comes, for folks who are in some higher wage brackets. I know, as you mentioned, President Biden has made it pretty clear regarding that line of demarcation, at 400,000 and then at $1 million. But I think the key takeaway here is, certainly to sit down in the coming months, talk to your financial advisors, understand if any of these changes will impact you directly, and where there's opportunity to take action on some of the recommendations that Jeff's provided us today. Speaking of questions, down at the bottom, there is a button that says Q&A, and I'll just invite everyone, as you listen to Jeff speak and as we listen to Cliff here in just a moment, as a question may come to mind, feel free to click on that button, type in your question, and I'll be monitoring that at the end, and we'll do our best to answer a few questions live, and at a very minimum, answer those for you individually after the call. So please take advantage of the Q&A. And with that, Cliff, I will turn it over to you and walk us through 2020 and what to expect in 2021.
Thanks, Craig. All right. Good afternoon, everyone. Thank you so much for joining us today and for the time. And as Jeff said, for the opportunity to come and work for you. It's certainly not something that we take lightly. And I hope, as you'll see as we go through the presentation, that we certainly do put a lot of time and effort into what we're doing, not only on the planning side, as Jeff alluded to, but on the investment side as well. And so what we'll do today, we'll start with a brief review of 2020. I've got some pretty interesting stats that we'll go over. We'll talk about the market outlook and the economic outlook for 2021 and the setup as it relates to valuation. Then we'll kind of hit briefly on strategy and positioning as to what we're doing in the portfolios. And then last but not least, certain data points and things that we're watching that will either confirm or deny our hypothesis. Couldn't resist. For those who have joined us in some of the kickoff events before last year, Back to the Future was a theme, and doing some prep, someone sent me this gift, so I had to include it. But 2020 was certainly a year for the record books. A couple of interesting market stats. So it was the fastest 30% drawdown in history for the S&P 500. It only took 22 trading days in March to fall from the highs in late February. And compare that to 08, 09, the initial 30% drop took over 250 trading days. So a much faster cycle. And then consequently on the rebound, it only took 121 trading days to get back to the prior high, which was February 19th. So, I make some jokes about how many careers we lived through in a single year. And it was definitely one I'll never forget. You all may remember there was a day, I believe it was the 1st of May, oil went negative, got to as much as a negative $40 per barrel for the price of oil, which was incredible. And then last but not least, the first time in history that the interest rate on the US 10-year Treasury fell below 1%. It actually hit a low of about 35 basis points there in March as well. Those were some dark days, but we certainly made it through. So from a return perspective, we spend a lot of our time and analysis on the macro environment and positioning in sectors and factors. And so as you see, it was a good year for the S&P 500, up 18% from an equity perspective. If you were fully loaded in technology, discretionary communications, we've talked a lot about those FANG stocks. So Apple, Facebook, Amazon, so on and so forth. You had a really good year in those areas. However, if you were in energy, financials, and real estate for the duration of the year, you were down or you underperformed relative to the S&P. I'll call out international was up 7. Emerging markets were up more or less in line with the S&P. So pretty good year overall for equity market returns. When we look at it from a factor perspective, so we do a lot of work on sectors and factor concentrations. It was really growth momentum, which are where a lot of those high tech firms reside, and then toward the end of the year, high beta did well also. But if you were a value, or especially for our income oriented investors, we do have some equity income oriented portfolios, which were all positive for the year, but those factors were actually down. So high dividends were down 7%. As we'll see here momentarily when we look at valuation, I don't want our equity income folks to be disappointed, because when we look at valuations, what we will see is that really the best area on the board from a valuation perspective are in these areas here. So not only do we want to look at the returns by sector and by factor, but also from a quad perspective. As you all may be aware by now, we use a quad framework, which I'll go into the details on that momentarily. But this slide really speaks to how value added this quad process is. So what I've got here is the S&P 500, where the markets really began to price in that quad 4 scare earlier in the year. Had the big drawdown in March and then the subsequent rally. What I've got on the lower ends of these charts are sector returns. So top 3, the S&P, and then bottom 3. And so I'll highlight again the power of the quads. Going into quad 4, these cyclical areas are not where you want to be. But then I'll draw your attention over here to the fourth quarter. So even though energy was down 33, financials were down 2. If you made that pivot right, going into, we really started getting positioned in kind of this late September, October time period, the more cyclical areas of the market were what led. So we were able to pick up a bit of incremental alpha over the market by making the right call on some of those sector positions. So brief little pat on the back, but that's really the story for 2020. But what's most important and why you're all here today now is really to talk about 2021. And so let's kind of dive in there. We'll start with our view on the business cycle, which again, this is the piece of the bit of our process really that informs our much longer term view. So think 5, 7, 10 years. But the important takeaway is that we believe that we are now past the troughing point of the recession and are turning the corner toward the start of a new expansionary cycle. And so we're actually already seeing that from a profit perspective. This graphic here goes back to 2016. This is quarterly profits, not only of the S&P, but also from non-publicly traded companies and small businesses, so on and so forth. This metric accounts for all profits in the U.S. economy. And you can see that, and this is from the September quarter, those have already begun to inflect higher, right? So this adds to a bit of our conviction level as we think about where we have been from a business cycle perspective, where we're going. And I think really the good news here is that if we're right, and barring any further setbacks from a virus perspective and potential for another mass lockdown, we think this number's got some pretty good room to move much higher here over the coming quarters. So I'll do a quick process review. I mentioned the quads, and so this is our framework which views the world in terms of rates of change in GDP growth here on the y-axis, and rates of change in inflation on the x-axis. And this is really important because not only does this drive the profit cycle, but growth and inflation also are causal factors that drive returns. So this is an example of the S&P 500. Quad 1 is where you want to be really bulled up versus quad 4 where you really want to be risk off. I've got the hit rates plotted here in these on this graphic. So I'll call your attention to quad 2 because that's the forecast for the next 2 quarters. Positive returns, strong hit rate. We'll kind of talk a little bit about what that means. But quad 2 is where both GDP growth and inflation rise together simultaneously. Our model is picking up pretty solid growth, really starting in 2Q 2021. And then from an inflation perspective, even the possibility of getting up toward a 3 handle in inflation in this first part of the year. Before we hit the potential for a quad 4 in the third quarter, which is where both growth and inflation decelerate. And that's really where you want to, again, reduce your overall risk. So at this moment in time, for the time being, if the forecast plays out as we anticipate, should be very supportive for equity markets for at least the next, we'll call it 4 to 6 months, before the market does begin to price in a bit of a soft patch, likely in the summer. And then from there, obviously we're going to be very data dependent, as we always are, to kind of reassess and understand the path forward, really for the second part and the latter part of 2021. So that's the story from the quads, and we're going to talk about what this means from a positioning perspective. But before I do so, also just want to briefly hit on valuation. We're getting a lot of questions, from clients, from advisors. The markets have been on a heck of a run. Valuations from a PE perspective are pretty lofty. What's your take on that? And the answer is, and these graphics do a pretty good job of explaining it, is that over the shorter term time horizon, so we'll just say a year or less, valuation is nearly meaningless, right? And so what we're looking at here is forward returns. So this is 1-year returns on the Y, PE, so price to earning ratios on the X, going back to 1995. So what we'll see is kind of where we are now, this 22, 23 times forward earnings. The model would suggest that, you should expect a very low rate of return in your equity portfolio. But when you look at the actuals, there's actually 0 data points that support that, right? You've got returns anywhere from kind of plus 25 to minus 30, and very few in here kind of what you would anticipate. But that over a longer term period, so think 5 years plus, you can see just how much tighter, right, the results have been. So from a 5-year perspective, we think that clients and investors should be ready for likely below average returns until we get a bit of a normalization in the price to earnings multiple, which will either happen by a correction or by a strong ramp in earnings. So this is really important as you think about the longer term planning perspective. Jeff walked through various strategies that we're looking at from a tax perspective, but as you think about things like savings and potential retirement dates and things like that, all of our planning software already uses some pretty conservative assumptions when we plug in our return expectations. But I think the key thing to think about here is that forward-looking returns, at least for the next bit, will likely be a bit worse than they have been over the past decade. We also wanted to provide the view from both, again, a sector perspective and a factor perspective. This is just using some iShares ETFs and some SPDR ETFs. But what we've got here is the forward multiple, and then this column is all relative to the S&P. So you can see that discretionary, energy, technology, some of these sectors are a bit expensive relative to the S&P, whereas things like financials, healthcare, utilities, so on and so forth are a little bit less expensive. Then on this side, we're looking at what's the 5-year average of the time series. So the average multiple for consumer discretionary has been 21 over the last 5 years. We're pretty high, pretty frothy when you think about that from a current day perspective. A lot of that's driven by Amazon and perhaps Tesla, which are now 40% of the ETF. So there's some concentration things to consider. But what I'll highlight here is, again, for our value in our equity income oriented investors, the longer term setup, again, valuation is more of a driver for long-term returns. The longer term setup is actually really good for income stocks. So we'll certainly encourage folks not to get too enamored with a lot of the hot FANG names that have run, but really know why you own what you do and really make sure you're sticking with the plan. So from a global perspective, I won't spend a whole lot of time here, but this is the S&P versus international, right? So we also are big fans of international relative to the US, both from a valuation perspective, but then also because of our outlook on the US dollar, which we think will continue to drop with continued stimulus likely to come from Washington and from the Fed. But you're getting about a 25% discount on a PE multiple and nearly double the yield in developed international. So we're doing a lot of work now on looking at complementing what we already have with some international names, especially in the income portfolio. Same story here with emerging markets. We like emerging markets, which already had a pretty good year last year. We think there's a lot of room to run, again, from a valuation perspective, where we're a standard deviation below the long run mean. That's the story for equities. Want to hit on fixed income here as well. A couple of things to point out. So one, first and foremost, what I've got circled here in red are that the starting points for yield or for the interest that you get are pretty much at all-time lows. So this is important because within fixed income, historically speaking, the overwhelming majority of the return that you get comes from the yield and not from the price appreciation. Price appreciation is really typically more of an equity return premium. Now, I say that, and 2020 was really the exact opposite. We had pretty low yields, rates fell, and so we did get some decent price appreciation in fixed income. But we think that's likely to not be the case going forward. And we'll kind of talk a little bit about why that is. But the other thing to consider from a fixed income perspective is what is called duration risk or interest rate sensitivity. So as you know, bond prices and interest rates move in the opposite direction. And so if you're banking on the interest that you get to be the part of the overwhelming part of your return, and you get a rise in rates, I'll call your attention here to the U.S. aggregate. This is essentially the S&P 500 for the bond market. A 1% rise in rates with the current construction and current makeup of the index is going to wipe out 5% of your returns once you account for the interest that you get. And if you compare that to the amount of yield at 1.12, we're talking 4 to 5 years worth of returns that can be wiped out by a fairly small rise in rates. Now, the Fed has come out and said that they're going to keep rates low for an extended period. They currently control the short end of the curve, so the very short-term rates. The long end of the curve is more so influenced by supply and demand. So while we don't think the curve will meaningfully shift, we do think the back end could move higher, which would certainly bring this phenomenon into play. So that's the setup. We kind of ran through where the markets are, and what we want to do now is kind of talk about positioning, where we are and where we're likely to head. So as we saw quad 2, we refer to that as a reflationary environment. So during quad 2 periods, we want to be levered to economic growth and economic cyclicality. Things like industrials, financials, some of the more beaten up areas of consumer discretionary like travel and leisure, things like that have really been left for dead with coming out of the COVID situation. And we want to be underweight things that are interest rate sensitive, because we think rates will likely be moving higher here for at least the next 2 quarters. So that's out of things like real estate, utilities, consumer staples, so on and so forth. We still like technology, we still like growth, but those tend to work a little bit better in quad 3. So we really want to be kind of widening out some of our exposures on the equity side. On the fixed income side, somewhat of a similar theme, right? So we're going to want to underweight those core kinds of bonds that have that low yield and high interest rate sensitivity into things that are a bit more cyclical as well, so that we kind of equalize that yield and duration relationship a bit more, gives us a better trade-off. But what we don't want to do is turn our fixed income portfolios into something that looks and moves just like our equity portfolios, right? We want to try and boost our income a little bit, but we don't want to look like an equity. And so this is a pretty neat graphic from JP Morgan that I pulled and have added a bit of color on it. But here is where the U.S. aggregate is. So that's the S&P 500 for the bond market. Pretty low yield, pretty low correlation to equities, right? What we're trying to do is kind of bump our target yield exposure to, we're going to target 3.5 to 4% yield, but not take on too much equity correlation, right? So if you load up on things like high yield and convertibles and things like that, you really, your bond portfolio no longer provides the protection that it would historically. So it's really a balancing act. But the good thing about the fixed income market is that there are a lot of different pieces to the jigsaw puzzle that all move in pretty different ways. So we've got a lot more license to get creative on how we fit those things together to, again, achieve our targets of a decent yield given the environment, but also keep that volatility low and not act just like equities. So that's kind of what we've talked about in these first two boxes. I will call out this section here, alternatives, because this is really one of our higher conviction ideas for 2021 and really and beyond, due to the rate environment and the macro world that we're living in. So the alternatives piece is a standalone portfolio, which we launched at the end of 2019. Had a pretty good year last year, as well as we got it off the ground, but really have it dialed in now to our goals of reducing risk compared to equities, but then also enhancing your return over that fixed income portion of the portfolio. So if you can increase your return and reduce your risk, that's really what investing is all about. So it's something that we are really interested in. We're really bullish on for 2021. So if you don't have any exposure to alternatives in your portfolios, definitely reach out to your advisors. Some of the areas in alts are a bit more esoteric. So we're going to be doing a lot of communication on the alt strategies in 2021. But again, I would encourage folks who may have interest, please do reach out to your advisors. Shoot me a note. Would love to kind of get into the weeds a bit more. So as I mentioned, we are positioned for robust economic growth, a weaker US dollar, and a return of inflation. So as you know, if you've heard any of our presentations, or if we've gotten a chance to meet or talk on the phone even, my team is huge on process, right? And so we're very data driven. We're long on things like macroeconomic data, market signals, so understanding how risk flows through currencies, interest rates, commodities, so on and so forth, looking at the whole mosaic, right, rather than just anchoring on stocks or sectors. Things we worry less about, feelings, valuations, kind of in the short term, growth versus value, what's going on with GameStop. I'm sure you've all seen some of the craziness going on in some of those sectors of the market, but really does not impact what we're doing on a day-to-day basis. But what does impact our view is when we see things within the signaling process or within our data analysis process that disconfirms or opposes our hypothesis. So I'll call out a couple of things that we're going to be watching very closely. Inflation drivers. So that's usually in the form of money supply. So we're looking at M2 growth, velocity of money. If we see M2 begin to roll over or velocity stay depressed, that would get us a bit concerned about the forecast for inflation. If we see spending data begin to drop off aggressively or take a turn worse in the labor markets, those things are from a data perspective would get our attention. From a signaling perspective, again, the view is for a weaker dollar. So if we see dollar strength accompanied by drops in commodity prices like copper and oil, decreases in interest rates, accompanied with some trending volatility, those are really the signals that would get our attention that hey, something's not lining up. We need to go back to the drawing board and get ready for a different scenario. So if you kind of think back to the quads, growth and inflation higher in quad 2, the exact opposite would be quad 4, where both in growth and inflation decrease. So in that scenario, we'd be wanting to do the exact opposite of what we're doing now. So we would go long duration in interest rates. We would get out of all of our commodity exposures and more of the cyclical exposures in favor of things that are less dependent on economics and inflation. So with that, I'm going to hand it back to Craig. I know we covered a lot of ground here. I did post some key takeaways that I'll let Craig hit on and certainly want to open it back up for any questions. So thank you again for your time and for your attention, and again for the opportunity of being able to work for you.
Cliff, thank you. Great presentation. We know how hard you and the rest of your team work on behalf of Cornerstone and our clients. So thanks for, thank you for the dedication. Thank you for the presentation. I believe, we'll have the presentation available for replay up on the website. I want to thank all of our financial advisors, the rest of the team. I see many of you on the call today, and I think as Jeff and Cliff both commented on, just encouraging you to, if you haven't already done so, get some time, with your financial advisor, review the outlook that Cliff just walked through in the context of your portfolio, in the context of your goals, in the context of your time horizon. And the same is true for some of the material that Jeff walked through. Again, understanding everyone's situation is unique, understanding your own unique tax situation, your own unique set of goals as it pertains to your family and perhaps for your estate plan. And so, with that, we're coming up on the top of the hour. And so I'll just close by thanking everyone again. For those of you that we haven't talked to yet, just great opportunity to wish you all a happy new year, happy 2021. And we'll look forward to seeing all of you again, hopefully in person sooner than later. So thanks again, everybody. Thanks for joining us today.